This podcast is provided for educational and informational purposes only. While every effort is made to ensure that information is accurate and reliable, the Luna Group does not make any expressions or imply warranties of any kind, including for accuracy or completeness. This podcast is neither a solicitation nor an offer to buy or sell financial products, and of course, past performance is not a reliable indicator of future results. Any information contained in this podcast is general in its nature and does not take into account your personal circumstances. Please direct any questions in respect to your personal situation to your financial advisor or tax professional before acting on any information contained in this podcast.
Hello, and welcome to our latest Stamford Brown SB Talks podcast. I am once again today joined by our Chief Investment Officer, Ashley Owen. Today is Tuesday, the 21st of December. And Ashley and I are taking a look back on the year and looking forward to 2022. Welcome, Ashley.
Welcome wherever you are in the world, Australia, around the world. It's probably most of you are back in Australia now and not heading off far for Christmas, but welcome.
Thank you. Now, Ashley, starting off, we approach the end of the year. Again, it's been broadly a positive year for most markets.
Yes, it's been a 2021 is we were hoping, of course, 2020 was behind us and 2021 would be back to normal.
Virus-free, yeah.
Virus-free, but that didn't happen. And as we look forward to next year as well, who knows what sort of variants are going to come. But 2021 wrap up for the year, basically a bit like last year in that the rich got richer. Anybody who owns assets got richer. Quite deliberately, monetary policy is to get the rich richer, the trickle down, hopefully some of that will trickle down, but the rich got richer. Anybody who owns shares is up, even broad markets, US markets up probably 20-ish%, 25%, which is most of the world's big stocks. Australian market will be up sort of 10-12% this year. Most European markets are similar. Japan, China's had some problems for sort of other reasons, but they're small. But basically, shareholders, I don't know, most of the friends and family I know had a win in something, in Afterpay or a takeover, an IPO. So it's very hard to find somebody who lost money on something globally.
They're probably not talking about it if they did.
Well, it's pretty, I mean, in a bubble, everything goes up. We had the speculative peak probably in March, April, that the meme stock went mad in January, February, March. We had the exchanges.
We had all the SPACs and a lot of the speculative money raising. Yeah.
Most of the speculative fever peaked in about the first half of this year, March, April, May. The second half of the year was more cyclical stocks, industrial stocks, consumer stocks doing well with the opening up of borders or the restarting of spending. So share markets around the world will have their third great year in a row. It's hard to, I mean, we had three great years in 2005, 6, 7, ended with the great GFC. We've had 2012, 13 and 14 were also very good years, driven by QE. This last 3 years, even with COVID, has been very good for shareholders around the world. Again, supported by free money and free debt. So it can't last, but 3 good years in a row is actually pretty good. Late 20s, then the 29 crash, so late 60s, then the 70s disaster. So 3 good years in a row is not as good as it gets, but you're relying on a lot of things going right. And we've had those go right, so that's good. So asset owners of the world did very well this year. Property owners did very well. Even you did nothing else and sit in your house, it probably gained 20%. You can't spend that, and you'll probably lose some of that when interest rates rise. But still, asset owners, particularly geared asset owners with cheap debt, did very well around the world. So the rich got richer, unprecedented number of billionaires minted around the world, in Australia and pretty much every other country as well. So rich got richer. The other side of the coin is 2021 was a year when there was an additional 100 million people go back into extreme poverty, which is less than $1 a day. So 100 million people back into extreme poverty. Most of that was in Middle East, Africa, South America. And if you look about the inequality rising around the world in wealth, not only wealth, but also incomes, particularly in COVID, but also access to viruses, inequality and access to viruses, you can see that very marked around the world. So the virus pandemic is still, Delta's still running riot, and then Omicron's going to come into the emerging markets. So that's just a reminder that everyone's done well. Rich people have done well. All of us have done well. We're in the top 1% in the world in terms of wealth, which is actually pretty a low threshold to get into. But the bottom half of the world still only own less than 2% of the wealth in the world. So the top 1% in the world own about half of all entire wealth in the world. So we think about that at Christmas and say, well, what can we do to help the less fortunate in Australia and around the world? And that's what we think about on the break on the beach when we go. So rich have done rich, done very well. The poor have done much worse than the rich, and it's up to us as a nation and as a country, as people, to do something about that over Christmas and start thinking about the long term.
Yeah, no, I think the last couple of years has certainly shown up probably an increasing spotlight on the inequality in the world, and wealth inequality, and even the wealth transfer, which has just got more exacerbated. So I can see that will be an increasing point of focus over the years ahead. As we come toward the end of the year, markets probably let off a little bit of steam, and I think there's a bit of a pause and a look forward into what 2022 might bring. Big factors there obviously always remains sort of the monetary stimulus side of things, Jay Powell indicating regarding the tapering of rates, and the rise of Omicron. Very rapid spread across much of the world now, which causes a little bit of a pause and a rethink with regard to what was the assumptions in terms of the vaccine rollout and the impact of where we go from here in the pandemic.
Yes, so we had the new thing, of course, is the Omicron, the new strain. Was always going to be strain after strain after strain. The viruses, as far as I know, they reinvent themselves and they try and get around problems, and they try and mutate to try to expand, and like naturally they mutate to survive. So like any other animal form, or life form. So the infection rates, we had a peak in January. Don't forget that we had no vaccines really around the world last year. Vaccines were this year's story, 2021. So the infection rates and the death rates peaked in January this year.
So the Northern Hemisphere winter and the flow through from that before the vaccines were rolled out heavily.
And then we had a peak in about April. Then we had the Delta peak in August this year. Now we've got another peak. So infection rates around the world, new infections per day, are running at around about 630,000 new infections per day globally, which is actually pretty much near what it was in January, April and August. So you've got a three-hump camel, and the infection rates of Omicron are pretty much 700,000 per day on average, which is back to what they were in the three previous peaks. That's the bad news. The good news is that the death rates are running at around 7,000 a day, which is about half what they were in the previous three peaks. So if you look at the three-hump camel for the infections, 1, 2, 3, and then we're now on Omicron, which is the third one, the death rates are actually coming down to half what they were. So that's the impact of the vaccination. So we're going to have these peaks in particularly as countries open up. So we're now in the Boris Johnson world, where every state in Australia is now saying, look, we're going to get infections and deaths. Well, we got to go on. So this is what Boris did 6 months ago. And it was painful, but that's what the plan A now is for all countries. So the infection rates, we're going to get those. The death rates is dwindling. And even with the Omicron, it's running at around about a bit above 7,000 a day, which is less than half it was back in the previous peak. So that's vaccinations.
I was going to say, well, even in addition to vaccination, some of the countries like the UK that had a very significant spread of the vaccine their summer, will have a certain amount of herd immunity starting to build from the quantity of people that have actually been exposed to it in addition to the vaccinations. That's
right. Now, I was getting a bus in this morning past Royal North Shore Hospital, which is where I got my first test probably a year ago now. The North Shore Hospital is about 300 or 400 metres up into the park, into St Leonard's Park. The queue for the vaccines was right along. They've got a massive sort of
snake line, yeah.
And then it goes down the road, and then it goes along the Pacific Highway up into Crow's Nest. And this is 100, probably 1,000 people just in that one queue alone. So we in Victoria, in New South Wales, we're doing around 100,000+ per day, which is an extraordinary number of tests. And people are getting vaccinated as well. I'm getting my third jab this afternoon, which is 5 months after my second jab. Most states in Australia, apart from the North Queensland anti-vax and the Byron Bay, there are chunks of people who don't believe that flat earthers. But apart from that, 90% plus second vaxxers, which is actually pretty damn good. So Australia was very slow. It's not a race. Australia was very slow we're now one of the top countries in the world in terms of double vaccinations, and now into our third vaccinations, whereas most other countries, US, Europe, were quick last year, but they've plateaued at about 50, 60%. So the global vaccination average now, right now today, is 46% double vax, which is actually not that high. It's less than half. Most of the problem is in emerging markets in Middle East, Africa, South America.
But they just don't have access to the vaccine.
Exactly.
Yeah.
So as a world, we're still less than half vaccinated. So those death rates are going to keep running on, albeit at lower levels, until we get more vaccinations around the world. So we're getting there. But certainly 2021 was supposed to be beyond, but COVID is behind us. It wasn't. It was still heavy COVID. Probably the same sort of issues will be reoccurring next year. Meanwhile, we've got the monetary front, which we'll talk about, and we've got the fiscal front, which we'll talk about.
So on the monetary front, first of all, Jay Powell indicating potentially tapering out by March. Obviously, markets watching that very closely, because after that, the next move is on interest rates.
Yes, so the reason why company revenues and profits and dividends have done well this year and share prices have through the roof this year is because money's been thrown at markets and their monetary policy, interest rates at zero, free loans, cheap loans programs from the central banks. A lot of that flows straight into company profits and company dividends, which is great for shareholders like us, terrible for the poor, but great for the rich. The fiscal side, which is government spending, again, free money for everybody. We had the JobKeeper and JobSeeker and job this, job that, job. No one cares where it went. The government just threw money everywhere, even though it went to dead people and foreigners and all sorts of people who pocketed it straight into company bonuses and directors' bonuses. They don't care. So that was just a free money bonanza, all of which has got to be paid by our grandkids, but they don't worry about that. A lot of that goes straight into, so that the other winners of the world are the consulting firms who made literally tens of millions of dollars from these ridiculous government consulting contracts. And I read a whole list of them on the weekend, $60 million to help consult on how to spend money on staplers or something. They're just mad government spending on their mates in the consulting land. So they're the winners of the world. So the monetary side policy, which is interest rates at zero plus free money programs and quantitative easing, which is money printing by central banks to keep rates low so the governments can borrow at cheap rates forever. The big change this year, particularly if you look at the share market sell-offs, we had a brief one in about March, April, when there was a bit of an inflation scare. We had another one a couple of months ago. We're going through another one now, which is basically the market realizing that interest rates at zero aren't going to remain forever. Now, central banks, led by the US Central Bank, Jerome Powell, saw inflation coming through. There's inflation everywhere. Everything you buy is more expensive than it was 3 months ago, 6 months ago, a year ago. Food is through the roof. Building materials are through the roof. Rents are through the roof. Every aspect of oil is through the roof, utilities, power, so everything is through the roof. Central bankers up till last month said, we see it where we don't believe it's transitory. So Jay Powell invented this word transitory to say, well, inflation is not going to be a worry. We're going to keep rates low forever or for many years. Over the last month, central banks have realised that the inflation that they are seeing through the numbers is not transitory. So Jay Powell about a fortnight ago said, we'll put that word to bed, no longer transitory, inflation's with us. So the big change over the last 2 or 3 weeks has been the realisation that central banks will start to ease out of money printing. So the US is they schedule to slow the rate of bond buying from $120 billion a month down to zero by June. Last Wednesday, he said, look, we have to do it quicker. We're going to get out by March. It may well even be sooner than that. And then he's saying we'll have at least 3 rate hikes in the US next year, which is only, we're talking about probably 3 or 4 months before the first one. So, and it could well be many more. The problem, well, they're not the problem, the characteristics of central banks is, if you imagine a car, we're driving along the highway, we're trying to see what we're seeing out the window so we can steer the car. The central bank is sitting in the back seat, facing backwards in a station wagon on a 9-seater, and they can only see what's going on after the car's passed it, and it's in their rear vision through the back windscreen. So central bankers, because of that, which is a whole lot of delays and lags in their thinking and their observation of data, reporting, debating, doing something, seeing it work, they take months. So central bankers almost always have to act too late, because they wait, And then they say, oh, Christ, and they have to go too hard. So
they got to slam the brakes much harder at that point.
Slam the brakes on much harder. They act too hard, too late. Almost always. Not always, but almost always. And that was the case in the 1929 crash, 1987, the tech wreck. Pretty much everyone, the GFC, they acted too fast and too late.
Is it realistically preferable now that they're being more realistic in their outlook in terms of potentially not trying to hold off rates for another 2 years or 3 years, has it been the case, or what had been their communication up until recently?
Yeah, that's right. So one of the most common question from clients these days is, when will rates rise? Now, we're blessed with probably the best investment committee in Australia for our sort of firm, or even a large firm. We have Don Stammer, who's a market guru, ex-central banker, ex-reserve banker. He hired the last 4 Reserve Bank governors, Don Stammer, and he's been on our committee for 10 years, 6 years. We've just recently put on Ian McFarlane, who was the central bank governor in Australia from 10 years under the Howard Costello years. So we have put the best central bank brains in Australia, this part of the world, and they can't tell you when rates are going to rise. What we can do is observe the conduct and the language of central bankers around the world and try and look at out of the front window so we can see what they're going to see out of the back window in 3 months. So when they have to hit the brakes hard, we know roughly what they're going to do. So that's as good as we can get. What we do know is that interest rates in the US will rise probably 1 or 2 or 3 times within 6 or 8 months. This time next year, cash rates in the US will probably be 2-ish%, give or take. It's now 0.
Yeah.
In Australia, the different parts of the world will have different things going on for different reasons. Japan, Europe being the 2 big ones. In Australia, our central banker here, Philip Lowe, has been a bit slow on the he's sitting in the box trailer at the back after the cars are driven past. He's been a bit slow to realise that inflation's a problem which needs to be countered by rate hikes. There's a few reasons why.
He seems to be holding a pretty hard line on their long time horizon of not increasing rates.
Yes, they had a 3-year plan for April 2024, and they pegged the 3-year bond yield to 0.25% or 0.1%. And that was always a mad thing to do, and he had to give up. They abandoned that famously last month and said, we can't keep throwing money at buying bonds. We've lost $8 billion last year. The Central Bank in Australia lost $8 billion on the market value of the bonds it bought during QE, and there's more to come. So they simply ran out of money. They physically could not buy enough bonds, their balance sheet. So taxpayers of Australia next year will have to tip in probably $4 or $5 billion to restore the capital of the Reserve Bank, which has just blown it on the bond buying program. Stupid decision, bad politics, bad policy. That's behind us now. He's given up on that. So 3-year bond yields are now about 1%, whereas they were trying to be pegged at 0.1%. So bad experiment, didn't work. So all of that means that whereas he planned to start raising rates in 3 years, middle of 2024, that's probably going to be a lot earlier now, probably even next year. So the difference between the US cash rate rises, which is 0 now, probably going to 2-ish% next year, this time next year, and the Australian cash rate rises, which is 0 now, maybe going to 0.5%-ish this time next year, maybe more. That's important for the exchange rate. A higher US cash rate, consistently, not just for a month or 2, but for say 6 to 9 months, 12 months, a higher US cash rate than an Australian cash rate means money will come from Australia and be thrown into the US market, and also Japan and Europe. So the US dollar was probably going to rise because of that flow of capital out of Australia into the US. People will buy Aussie dollars and go, they'll borrow Aussie dollars and go and buy US dollars, and they'll get a carry trade of 1%. So it's the oldest trick in the book. Everyone does it all over the world, have done for decades. So that difference in cash rates is important for the exchange rate. So probably the Aussie dollar is sitting at around 71 odd cents US currently. It's been very strong post-COVID, but it's come off over the last month-ish. So it'll probably be weaker as the US cash rate rises faster than Australia. So for exporters and importers and people with foreign portfolios who need to hedge portfolios, that exchange rate for Australia against the US is an important decision as a result of US cash rates rising faster than in Australia. So the monetary story is that free interest rates and zero rates forever will no longer last for more than probably 3 or 4 months, and we'll start to see a lot of pressure, inflationary pressure. Inflation in the US is running at like a 30-year high at nearly 7%, and a lot of that's baked in inflation. It's like oil prices, food inflation, rents is a third, rent occupation costs is a third of US CPI basket, and rents are up 10, 15, 20% across the US. It's not going to go away. So, and as rates rise on mortgages, those rents will have to be under more pressure. Mm-hmm. So the interest rates being very low forever is no longer the story. We're now going to see cash rates rises around the world. A lot of countries, UK, US, New Zealand, half of Northern Europe, Middle East, Brazil, South America, they've all put rates up. So Australia will be one of the slowest to do so, even though our economy is quite robust. Unemployment's now low 4-ish%. You can't find staff. If you do find staff, you've got to pay them double what you paid. You can't find pickers to pick fruit, so fruit prices have doubled. So inflation is coming through everywhere. Probably the wage inflation in Australia is not as high pressure as in the US. So there's a couple of reasons why inflation in the US might remain a bit higher than Australia. But inflation's here with us for the next medium-term period, and it will need to be countered by rate hikes. So those people who borrowed, like my daughter bought a first house in this year about 6 months ago. She borrowed at 2% fixed for 2.0% fixed for 3 years, which is fantastic. You'll never see that again in your entire life. So good on it. A friend of mine in Hong Kong bought a sight unseen property in Brisbane from a suburb he grew up in. He bought that and he borrowed 2.5% 5 years fixed. That's pretty hard to beat, and he'll be sitting back in 5 years laughing, having to refinance it at 6-7%. Lock it in as long as you can. And there's still deals there to be done, but certainly we've seen the days of the lowest rates we'll ever see in history are probably behind us.
So you're sort of setting the scene that 2022 will be the year of, I guess, a bit of return to normality and a realization of, get a bit more of a clear picture about the timeline of getting back there. I know next month we'll see us go through the quarterly review of asset allocation and markets, but without getting into the asset allocation side of things, what other factors are on your mind in terms of the outlook for the year ahead? There's always certain geopolitical factors and other things that do not influence asset allocation, but do influence the way that we look at the world.
Yes, so we've been, this last year and a half, we've been overweight global shares and I think neutral and Aussie shares. That's worked very well because global shares are through the roof. Even the global shares have returned around about 10% more than Australian shares over the last year, 2021, and also last year as well. So that's been good. Will we retain that? Don't know yet, but it's certainly the froth is gone, and with rate hikes on the horizon in many countries already, that bonanza and flow through to revenues and profits. Meanwhile, profits are the expectation of next year's profits are what drives share prices. Australian profits hit a hole. They dropped 60%, literally 64%. Last year from the previous profits peaked in 2019, actually 2018, they were down 2019, but they dropped about actual reported profits from companies in Australia dropped 64%, which is highest in any country.
In 2019.
In 2020?
In 2020, in the flow through, from 2019 to 2020 from the pandemic shutdown. Yeah. Now,
a lot of that was funny numbers. It was property trusts writing off $12 billion of property values, which have been put back in this year. So a lot of it's just accounting trickery. So
banks making provisions for losses that ultimately didn't necessarily arise.
Which was legitimate, but they didn't need to use that because of the pre-money bonanza from governments, which nobody expected. So the profit picture for Australia peaked in 2018, was lower in 2019, still very high, dropped 60-odd% in 2020. It is now back to what it was pre-COVID, which is the banks writing back bad debts. It's the companies that wrote off asset values are writing them back. Globally, the profit picture, again, globally profits peaked in 2018, down a fraction in 2019. They dropped about 40% in 2020. And again, banks and miners, for example, and iron ore companies, primarily in property trusts and retailers. The profits in 2021 already are well above what they were pre-COVID globally. So share prices are underpinned by strongly rebounding profits. And will that stop next year? Probably not. Profits will still go stronger next year. Borders reopening, people are spending, restaurants are open, bars are open. We'll have the odd lockdown here. A couple of states in Australia have locked down, and a couple of states in the US have locked down. I think Netherlands did a lockdown for Christmas, a couple of days ago. So there are problems like that. But by and large, revenues are rising, profits are rising, and dividends therefore are rising as well. So all of that is solid concrete dollars supporting share price growth. So
plus I think, as any investment manager, and none finer than yourself, of course, it's the opportunity cost. So if we're not in equities, where are we going? And are we going to bonds? And we spent much of the last 10 minutes talking about rate increases. Well, bonds is not necessarily a wonderful place to be, particularly if you've got longer duration in that environment.
So your typical pension fund around the world, sovereign wealth fund, pension fund, is a bunch of shares, and the rest of it's in fixed rate bonds. Always has been. That's the traditional asset allocation for long-term investment funds around the world and in Australia. The problem with that is, and the more conservative the portfolio, you might have a conservative portfolio which is say 30% shares, 70% bonds. That is not a conservative portfolio. That's a diabolically bad portfolio heading into a high interest rate, high inflation, or even moderate inflation environment. So the last thing you want in a portfolio, particularly a conservative portfolio, is government bonds, because they'll be hammered as rates rise and inflation expectations rise. So we've been pretty much out of bonds. Our entire defensive allocation, about 70-75% of our defensive part of our portfolios is not in bonds. It's in cash and high grade floating rate securities. Now, fixed rate bonds suffer when rates rise. Floating rate securities, company floating rate bonds, rise when rates rise, because the interest rate attached to those floating rate securities rises as cash rates rise. So we've been in favour of floating rate and fixed income, floating rate securities in our defensive side, which means we've been expecting a rate rise, expecting rate rises for the next 2 or 3 years, whereas the traditional fixed rate bond fund is going to suffer. Like fixed rate bonds around the world posted negative returns, let alone after inflation, negative nominal returns last year. In Australia, every country, including the US. It's quite hard, quite rare. 1994 was the last time there was a general bond market, bear market around the world. Because again, remember I said to you half an hour ago, I said central banks almost always act too hard and too late. The last time this century, in the last 100 years, that didn't work was in Alan Greenspan got out of bed in January 1994 and said, we're going to be preemptive. So he went too hard too early for the first time ever, never again. So that was the only time that fixed rate markets, fixed rate bonds around the world had negative years across the world. That was 1994. We had another one of those 2021, and you don't want to be near bonds when rates are rising and inflation expectations are rising. So on the bond side of portfolio, we've got a very small allocation to high grade corporate bonds, but most of it is in high grade floating rate securities, which increase in returns when rates rise.
So we don't suffer from that capital drag of the rising rates.
So we'll probably retain that part of the portfolio. We've had no commercial property. We took commercial property out pre-crash. We had LPTs, listed property trusts, and we took those out in 2019 and a bit in 2020. They've come back strong. This is retail property trusts, buildings, commercial buildings, shopping malls, what have you. They suffered very badly. They've had a good rebound this year, but they suffered very badly last year. And we think that shopping centres, the days at the Westfields, the shopping mall days of the world are gone. They'll still be there, but that's an era that was sort of a post-war.
I would say there's a broader long-term thematic there where you think the demand for retailing, it's definitely bricks and mortar is waning, and it'd be quite interesting to see what happens in the commercial spaces. A lot of firms have had, particularly larger organizations, close to 2 years at home now, and staff very much working to hybrid ways of working and other things. We'll see a lot of that. We're already seeing organizations downsize their footprint in terms of their head offices and things of that nature.
Yeah, large companies are still having trouble getting people back to work. I know a lot of large big banks, for example, have said, look, next February is a time we'll try and get people back to work. Now, small companies like we've had full staff here for 6 months. Well, not 6 months. We've had
6 weeks
last year. Yeah. About October, November, everyone started to come back. But anyway, it's a full office. Medium-sized companies have sort of half-half. I mean, talking companies with 1 to 500 employees, I know quite a few of those, and they've got some people that do Tuesdays and Thursdays. They're trying to work. Large companies are still out doing homework, which means playing with the dog and kids and homeschooling. Not much work gets done. They know that, but they can't control that. So a lot of companies are having a lot of trouble. So there's certainly been a step change. Even 3 or 5 years' time, when everything's normal, again, I suspect there'll be people who just naturally work 2 or 3 days a week at home or up at the beach house or something. So people are used to that. Technology is great. I did the same thing as you. We bought a couple of screens, a couple of bits of things on the desk, and everything worked perfectly, very efficient. Your setup's good. So I suspect that will affect
quite a bit of that's here to stay. Yeah,
that's here to stay. So I like Australian commercial property. I mean, office property. Whereas I'm much more positive on that than global commercial property, because Australia is unique in it's got these 4 or 5 major cities which have been growing pretty much forever for the last 200 years. Very unusual. So you can't build another Parramatta, you can't build another Chatswood, you can't build another St Kilda Road, you can't build another West Perth. So once they're built, they're built. So when you want to put up a new building, you don't put it up in the middle of nowhere. The Sydney city will be here in 100 years' time, 200 years' time. In the rest of the world in commercial property, that's not the case. If you drive through Europe, there's a town every 10 minutes. If you drive through the US, there's a town apart from Death Valley, there's a town every 10 minutes. So cities change, Detroit's die, Baltimore's die, cities change, and they change over time. So if you build a commercial building in a town in Germany or France or Italy or the US or UK, the chances are in 50 years that the industry that town relies on now will be gone. So Australia's not like that. Australia is a very immobile commercial base. So I'm quite happy with Sydney, Melbourne, Brisbane property, commercial property as a sector. It fell heavily, and it's probably not going to go back to the same strength it was pre-COVID, but still fundamentally quite strong relative to commercial property elsewhere.
And is your preference there, is it more towards unlisted or more the listed sort of vehicles?
Yes, we've used unlisted property trusts tactically. They had a great QE period in 2012, 13, 14. They are basically hurt by rising bond yields, which is what we see in the next 2 or 3, 4 years. So I would rather have, and we also use unlisted property trusts. Listed property trusts are very volatile. They dropped 90% in the GFC, and some of them never came back. The Centros of the world never came back, and a lot of bankruptcies. They have a few more layers of problems with them than unlisted property trusts. They have a lot more debt than unlisted property trusts, and they also have the share market volatility than the unlisted property trusts don't. So unlisted property trusts tend to have a stable price, which goes from $1, $1.05, $1.10, whereas the listed equivalent goes from $1 to 30 cents in a sell-off, which is just crazy. And they try and dump properties, and they get into all sorts of problems. So all clients would have 1 or 2 selected unlisted property trusts with good quality properties in those, and they can hold those for 5, 10, 15 years. So we're also putting together some single asset property trusts where a bunch of investors will get involved, and 30, 40 investors will go and buy a particular single asset, which will be an office building in Brisbane or Sydney or Melbourne. And we'll start doing those next year as well. So they're quite strong. You select them carefully, low gearing. They're typically locked up for several years, and you just sit and collect your rent. And when the property's sold in 7 years, you then distribute the profits. There's tax advantages in doing that. So that's something, long-term holdings of quality unlisted property is probably a part of most people's portfolios. In Australia, globally, it's less of there are more problems in the location problems, but in Australia, it's a good industry to be in.
Well, we've got natural population growth and economic growth.
Yes.
Ashley, that's a wonderful recap of the year. Any last final thoughts for our listeners for the festive season?
Well, we hope your Christmas party is not cancelled. We had our office Christmas party on Friday, which was fantastic. I mean, our kids' Christmas party in the office yesterday, which was good. And just watch out, stay safe, and we'll see you in the new year.
Thank you very much. Thank you, Ashley, and thank you to all our listeners. Have a wonderful Christmas. Take care, and we look forward to chatting again in 2022.
See you soon. Bye-bye.
Thank you.